students, welcome to our channel Accounting Explained @account.wise academy. This is the part 2 video of the NCERT chapter 1 of 11th standard accountancy portion. I have explained this in a very simplified way and with lot of examples so that you can understand the lesson very easily. If you want to look into the important questions and the MCQs of this chapter, you can look into the YouTube shorts of our channel. Now let us get into the lesson. In the first video, we have covered meaning of accounting, accounting as a source of information and objectives of accounting. In this video, we are going to cover role of accounting and basic terms in accounting. Who are all the interested users of information? Accounting translates business's financial health into a language everyone understands. So it translates financial health into a language. What is that language? Preparing profit and loss account, preparing balance sheet, preparing financial reports so that everyone can understand it on giving a glance of it, on seeing a glance of it. Okay. So what are the groups who needs this translation? They are internal users like managers and external users like investors. Why do managers need those information? Managers use financial information to make decision about everything from staffing to expansion of the business. Okay. Outsiders like investors and lenders also need this information to decide if they can trust on the company, and with that trust they can invest in the business, whether they can invest in the business or not. Ultimately, good accounting helps everyone to make better decisions based on the financial facts. Why do the users want accounting information? Previously, we saw that financial reports have to be prepared and have to be given to the public or the investors or to the managers. Why do they need accounting information? First, let us see owners or shareholders. They need the information to check their investments, to find out the company health, whether the company is doing good or not, and about the returns, how much profit I am getting because I have invested in that particular company. Okay. Next, directors or managers. Directors and managers need accounting information to compare performance with the previous year and the current year. Okay. They will compare performances year-wise. Ensure profit. They ensure that the company earns profit. Pay debts. And with the profits, whether we are able to pay our debts. Okay. And stay solvent. Solvent means stay in a positive way. Okay. Creditors. It is helpful for the creditors also. Why? They can assess the ability to repay loans and debts, whether we are eligible to repay loans and debts as a company. Investors decide whether to invest in the company. This I have explained earlier. Government or regulations. Why do they need the accounting information? They need accounting information to collect taxes, protect investors and creditors, and comply with legal requirements. Accounting as a source of information. Accounting generates information through various steps, not just for its own sake, but to communicate to different users. Who are the users? Like creditors, investors, governments, etc. Okay. It also considers the social impact of the company's activities, whether socially that the company is positive or negative, whether it is adding value to the society. Okay. Good accounting provides details for predicting cash flow, judging management's effectiveness, how much is our cash flow, and judging management's effectiveness, whether the management is good enough to carry on the activities of the company, and understanding underlying assumptions, whatever the assumptions the company has made, whether it is being properly carried out. This information helps users to make informed decisions based on company's financial health. So the information, source of information which is given helps to decide on the actions to be taken according to the company's financial health. Okay, whether the financial health is good or bad, accordingly they can take action based upon the accounting information we have received. Ultimately, clear and relevant financial information empowers users to make better choices. Okay, if you have given clear information about the company, it will be useful for the users like investors, creditors, etc. to take good choices about the company, whether to invest in the company or whether to give loans to the company, etc. Let us now see the role of an accountant as a financial accountant, as a cost accountant, and as a management accountant. So who is an accountant? An accountant is a person who gathers, processes financial data. Why does it gather and process financial data? To create reports for informed decision making. Okay. Financial accounting focuses on past performance and reporting to stakeholders. It is mainly prepared to report to the stockholders. Okay. Next, cost accounting analyzes costs of pricing and cost control within the company. So, it is used to analyze the cost, whether to decrease the cost or increase the cost according to the price, and to control the cost. When you control the cost only, you will earn profit. So, that is the main job of cost accounting. Next is management accounting. What does the management accountants do? They use the past data and future forecast and help managers make decisions. So they take the past data and they project the future so that it will be helpful for the managers to make decisions for the future correctly. So accounting has expanded to include areas like human resources and social impact accounting is also there. Okay. Qualitative characteristics of accounting information. Good accounting information needs to be reliable, trustworthy, error-free and accurately reflects reality. It should be reliable. Okay. Trustworthy. People should have trust on the accounts which you have provided information. Error-free. There should not be any errors. Okay. And it should accurately reflect the reality of our company. It must be relevant and it should be available on time. It should be useful for predicting future outcomes like we saw in the management accounting, no? And influences users' decisions. With that, users' decision can be influenced. Understandability is crucial. So, it should be as simple as that so that the users can easily interpret the information clearly and consistently. Finally, comparability allows users to compare an entity performance over time and against others. So, see if you are manufacturing some computers and there is a competitor for you, another computer manufacturing company. So, users, they should be able to compare your performance with the same company which manufactures your same product, that is a computer. It is like comparing apples to apples. It should be as simple as that. Okay. These qualities work together to ensure valuable and trusted financial information for decision making. See, it should be valuable and trusted financial information. And what for that is used? For making a sound decision making. What are the objectives of accounting? Record everything. Accounting keeps track of all financial transactions. So it should record everything, means not everything like hiring a manager and other thing. It should record only all financial transactions in a business, providing reliable historical record. Okay. Calculate profit or loss. By analyzing income and expense, accounting shows if a business made money or lost money during a period. What is the purpose of carrying a business? To make profit. So that should be done clearly, whether we have made money, that is made profit or loss, that should be done clearly. Okay. Show financial health. It uses assets and liabilities to create a snapshot of the business's financial position at a specific point in time. So by seeing the assets and liability, we can say about the financial health of a company for a specific point in time, that is for a year or for quarterly or for half yearly, etc. Informed decision making. Accounting reports, statements and charts provide valuable information for both internal management and external users to make informed decisions. Okay. Different needs, same source. While internal users might focus on cost and profitability, so internal users, that is the internal managers and others, they focus to reduce cost and to earn more profit. While external users have diverse interests, from investment risk to environmental impact, all served by the accounting information. The same accounting information can be used by the internal users for maximizing the profit and reducing the cost, whereas for external users, they can see whether their investment is risk free and whether it has good environmental impact for the society. Okay. Role of accounting. Accounting adapts. Over time, accounting has transformed to analyze and report on massive amounts of business data. So, first it was only recording. Later, now we are using accounting to analyze and report on business data. So, accounting is getting adapted to the new environment. Okay. Financial translator. It condenses data into reports that reveal a company's financial health and performance, making the language of business. It is the language of business. What does it do? It takes the data and prepares report from it. Okay. And from that we can find out the financial health and performance of the company. Informing decisions. Accounting provides quantitative financial information valuable to various users for decision making. So it gives financial information, quantitative, that is in numbers, to make various decisions. Okay. Focused on the past. There is some disadvantages of it also. Okay. Limitations. It primarily deals with historical financial data. Okay. It uses only the old financial data, lacking qualitative and non-financial insights. Okay. Use wisely. Recognizing these limitations is crucial for accurately interpreting useful accounting information. Though it has some limitations, we have to use it accurately to get the interpretations correctly. We'll see about the basic terms used in accounting. First, what is an entity? A distinct business enterprise is called an entity. Transaction, an event involving value between two or more entities. Okay, so there should be an event and there should be two or more entities involved in it. Assets, economic resource owned by a business. Assets are the resources owned by a business. Liabilities, debts or obligations of a business. Okay. Capital, amount invested by the owner in the business. Next is sales, total revenue from goods or services sold. Whatever the income we get from the goods or services we sell, they are called as sales. Revenues, amounts earned by a business from selling products or services. Okay, these products or services, for that if you receive amount, it is called as revenue. Next is expenses, cost incurred by a business in earning revenue. Whatever the cost is incurred by the business for earning revenue, it is called as an expense. Okay. Next is expenditure, spending money or incurring a liability for a benefit. Okay. Profit, excess of revenue over expenses during an accounting period, that is income minus expense is a profit. Gain, profit from incidental event or transactions, not from the regular transaction of the company, regular business of the company. If you are going to get profit from, see, if the machinery you are using and you are going to sell the machinery after some time, and if you are earning profit out of that, it is called as a gain, not a profit. Okay. Loss, excess of expenses over revenue. When the expenses are more than revenue, it is called as a loss during an accounting period. Discount, reduction in the price of goods sold. When you are going to give discount to the customers, then there is some reduction in the price of the goods sold. Voucher, documentary evidence supporting a transaction. There is a transaction you have made, you have paid to the customer. For that, you will write something in a paper that is called as a voucher regarding the transaction. Goods, products bought and sold by a business. Whatever the products are bought and sold by the business, they are called as goods. Drawings, withdrawal of money or goods by the owner for personal use. If the owner withdraws money and uses for his personal use, it is called as drawing. Purchases, total amount of goods procured by a business. Whatever the goods bought by the company for the business, it is called as purchases. Stock, goods or items on hand in business. Whatever goods you have in your hand, it is called as stock. Debtors, people or entities who owe money to a business. So you are a business. If someone owes money to you, then they are called as debtors. Creditors, people or entities who are owed money by a business. If you owe money to others, then they are called as creditors. So with this, we are completing the chapter 1 of the 11th standard NCERT accountancy subject. Do like our video and share it with your friends if you find it helpful. Subscribe to our channel, which will encourage us to make more videos like this one. If you would like to inquire about the accountancy classes which I take, or to get more worksheets for problems with solutions, contact us at acct.wiseacademy@gmail.com. Thank you for watching.